Hi everyone, it's Ari here. I wanted to give you guys a quick update on Intrepid Potash. Next week will be an interesting week for this company because they have a September 30th deadline uh, for the current extension or forbearance period for their covenants. And they said that at the end of July, they said that they have reached revised terms, an agreement on revised terms with the banks on the notes that they have, and that they were going to formalize these revised terms and then announce them hopefully by September 30th. Next week is the last week. It seems like the negotiations were promising. You can see if you read the press release, you can see that they had some positive language here. Let's see. We have made good progress and continue to work towards the final resolution of the debt covenant issues that we have been experiencing. We are grateful for the diligence and thoughtfulness of our creditors that they have demonstrated in the negotiations this far, and ask for patience from investors as we endeavor to memorialize these agreements in principle. It really seems like the outcome of this is going to be something that's not a dilution. Worst case, I think it would be a rights offering where the shareholders would be given the opportunity to buy shares at a discount, and the proceeds would go to paying down or reducing the level of the debt. I think more likely is they're going to maybe ask for some sort of security, or they're going to increase the interest rate slightly. They said that they have a new lender who's going to provide a new credit facility, so that's here. So we'll learn about who's providing the new credit facility and the terms on that. And those are probably the outcomes. The stock price, I've learned a lot more about this company over the last couple of months since I made my last video. The stock price seems very, very cheap. I like to call it ridiculously cheap. If you look at the HB solar mine for this company, and I have where did I put that? There's a investor presentation that shows that describes the HB solar mine. Is actually from 2012, and when you look at that, you can see there's an estimated 28 years of assets to be a productive life, and 5 million tons of potash that can be produced using the solar solution method. The way that works is they pump after a conventional mine is closed. They pump salt water into the mine, dissolve the potash, return the water to the surface, and then they dry it in these ponds. They're kind of interesting to take a look at. Let's see if we can get a photo. Yeah, so they look like this. And they have a dye that's added to help speed up the evaporation. The evaporation happens during the fall from into the early spring. And the point is that this one new investment that they've actually just finished in 2012, and they put a few $100 million into, this one investment with a 28-year productive life, 5 million tons of potash, with a $100 cost of production. If you assume at today's prices they can get about $100 per ton, you use the annuity formula, and you get that the value of this project is $183 million using a 10% discount rate. So annuity formula, we assume $100 of cash flow net of cost, and potash prices are in the 200s. Just assume they stay in the 200s, and that less shipping, you get about $100. They have a capacity of about 200,000 tons per year, and then the rest of the formula in my taskbar you can see is the annuity formula. I assume a 10% discount rate, 28 years, And if you let Google calculate this, you get $186 million, which happens to be in excess of the current enterprise value of the company. If you take the 150 million of debt, you subtract off the cash, which is almost 50 million, and then you add on the market cap of the stock, which is in the 80s, you're getting one asset, which is the HB Solar Mine, which is a low-cost asset, which is competitive with the Canadian assets and other assets. You get this one asset worth the entire company. So just this kind of quick back of the envelope valuation of the company suggests that you're really paying for this one asset, the HB Solar Solution Mine. There are other solution mines that you're getting for free. You're getting the Trio, which is the sulfate of potash magnesium, which is a specialty potash with less chloride that's used for like coffee and vegetables. You're getting that 100 years of that production for free, and that's sold at a much higher price because it's a specialty product. Only 2 companies produce it, Intrepid and Mosaic. And again, there's 100+ years of that, and that price has been more resilient to the downturn in potash prices. So plus you're getting a significant amount of deferred tax assets from the losses that they've been accumulating over the course of this down cycle, and you're getting all these other assets. So all of these assets are sort of the conventional assets. You can see why did it move? You can see they have the west and the east. These are shut down. The conventional underground is shut down, and here you have over again 140 years of production that's not being used right now because it's higher cost potash. You have the whole Trio, which is sulfate of potash magnesium. That's again 100+ years. And then you have these other mines, which are solution mines, and they actually have more production tons than right here. So there's about, I think, 5 million again tons here, and this is more, I think I'm a little confused. This should be conventional because they just opened this thing in 2012. So there's no way there's only 800,000 tons of probable reserves, and then they put in an investor presentation about 5 million. So you're getting a lot of stuff for free. Now the downside risk again is that they are in violation of the current debt covenants, but it seems like this week we're going to learn the new revised terms, and again I don't think that those are going to be as serious as the market is pricing the stock. This market is pricing the stock at 25% of tangible book value, and this is the only potash company that's written down their tangible book value. And if anything, if you look at the value, how do I do this? Buildings. Let's look. Yeah. So if you look at the value of their property, plant, and equipment as of 2015, end of 2015, you can see that they wrote down, for example, their machinery about $300 million. And they wrote down, and look at, they're recording all of their mineral deposits and development costs. All of that is valued at $123 million. That's less than the entire, that's less than the value of the HB Solar Mine that we just did. We got $183 million. So and at this value, which contributes to the book value of equity, which is about 400 million, which gives you a value of a share of $5.30. At this value, this is in that value, and I think that these are understated book values of the property, plant, and equipment. So I think this company has a price in the next 6 to 12 months between $5 and $10, and longer term, I think your potash is you have no substitutes for potash. It's an important ingredient. You have only a few suppliers in the world, again, Canada, Russia, and Belarus, really, and now China. But all of these countries rely on this sector for dividends, and there's no way that they're going to give away for years. They're not going to give away potash with no return or with little return. They're going to cooperate. You're seeing the merger between potash and Agrium. This is just going to help the situation, but it may provide some more competition for Intrepid in the Texas area because Agrium is a retail distribution system for potash and has a lot of network in West Texas. But it's in the news that Belarus and Russia and the Russian company Ukraly, I don't know how to pronounce it. They are likely talking with each other and may restart a cartel, which would be a huge catalyst. And again, I think this sector is very different from oil or the other commodity sectors. You still have a lot of the commercial mines held by a few companies, and and these companies don't want to give away the assets, the potash for no return, or for even a low return. And the cost of competing with these players is in the billions of dollars. Whereas in oil, the shift in that industry is now with fracking, you can very quickly, with low capex, set up additional supply to compete with the higher cost conventional supply and the higher cost development of large scale oil production. So this sector is very different. I think there's a lot of favorable attributes to this. If you disagree, please comment below. I'd love to hear your opinion because I'm very bullish on Intrepid Potash. And the insider, I showed last time that the CEO and chairman has been buying despite having lost a lot of money on paper, and the stock right now is $1.06, and I've been buying the last couple of days as to take advantage of this dip. But I think again, within 6 or 12 months, you could be seeing a price around $5, in excess of $5, and that's not that surprising. A lot of stocks, if you think that mispricings don't happen like this, just take a look at Freeport-McMoRan, which had its own story, but look at what happened. They were around $4, and then literally 2 months later, they're at $10, $11, and then 3 months later, they're at $14, which that's a $10 change times 1.3 billion. That's a $13 billion discrepancies in value in the course of 3 months. I think the market is not valuing the stock correctly because it's almost a nano cap now at 80 million market cap, and most mutual funds and other institutions are not going to be holding this kind of company. It's in an unfavorable sector, and it's hard to optically hold in your portfolio and convince. You have to then argue with your partners and explain to them why you're holding the stock. I don't think it's an easy story for people to tell, and but I think with the high uncertainty, again, they have I think a high margin of safety, and I think there's a lot of potential catalysts around the corner, including the announcement of revised terms next week. So I highly encourage you to monitor this stock and keep an eye out for the news next week. And again, I think the worst case would be a rights offering, which would just be a way of issuing securities to existing investors, so there would be no dilution if you participate, and we, the shareholders, would just pay down the credit card of the company, essentially. And the reason I believe this is because the founders own so many shares, and they have no incentive to dilute their ownership. So let me know what you think in the comment section, and thank you for